So in this video, this estate attorney is going to give you his top 5 strategies to avoid tax. I'm Paul Rabalais. I'm an estate planning attorney. I help our clients get and keep their legal affairs in order. And I've sat across the table from probably somewhere between 5,000 and 10,000 people over my 3 decades of helping people get and keep their legal affairs in order. And some people, sit across the table from me and they say something like, Paul, what I'd like you to help me do is I'd like you to help us set up an estate planning program so that me and my spouse and our children and our heirs can pay the maximum amount of tax possible. Just kidding. Nobody's ever said anything close to that. Of course, everybody wants to pay legally, of course. Well, some want to figure out how to do it illegally, but we're not going there. Everybody wants to legally figure out how much or how they can pay as little as tax possible. And there are some things where you can be proactive and pay less or no tax than you would if you didn't take action. And some things, as you'll hear me say in a minute, require inaction to take advantage of certain tax rules. So I've come up with my top 5 strategies to help you and your family pay as little tax as possible. Now, I will tell you, this video really isn't for somebody that's in their 20s and 30s trying to figure out what can they do today to really avoid tax on their heirs in the future. This is for those people who are, as one client told me last week, he said he's in the 4th quarter. So I think he's like 78 years old and he doesn't think he's going to live very long. But this video is really for those people. Maybe you're in your 60s or your late 60s, or maybe you're in your 70s, or maybe even in your 80s, maybe even in your 90s. But you're in that mode where maybe you've worked hard. You're kind of frugal. You feel like you've got enough, to live off of. You're not really worried about that, but you're in that mode of how can we keep it in the family, pass it along to the next generation with the government confiscating as little as possible. So I got my 5 strategies. 2 of them are related to the capital gains tax. 1 of them is related to the income tax, and 2 of them are related to the federal estate tax. Let's get right into it. My strategy number 1, many of you will be familiar with. It's make sure you and your family take advantage of the step up in basis. Or in other words, when somebody's in their 4th quarter, it may not make sense for them to sell assets that have appreciated significantly since they were originally acquired. So the cost basis of property transferred at death, it receives a step up in basis to the fair market value at the time of your death. So this eliminates an heir's capital gains tax liability on the appreciation in the property's value that occurred during your lifetime. Quick example, let's say you bought a share of stock for $20 and now it's worth $70 a share. And if you sold it during your lifetime, that's $50 of capital gain. You'd have to pay capital gains tax on that. But if you don't sell it and let your heirs inherit it, then when you pass away, that stock, which is worth, let's say $70, that's going to be the new basis for your child, for your heir who inherits it. And so that $50 of appreciation just goes untaxed due to the step up in basis. So many families try to avoid selling highly appreciated assets in order to get the benefit from the step up in basis rule. So that's number 1. Number 2 is a lesser known, but also a capital gains tax saving strategy. It's take advantage of what I call the double step up in basis. So when the first spouse dies, all of the assets in that spouse's estate, and quite frankly, if that couple lived in a community property state like I do in Louisiana, all of the community property gets a step up in basis when the first spouse dies. And that's great. We want to take advantage of that, for the reasons I just expressed in strategy number 1. But sometimes many years go by from the time that the first spouse dies until the time that the second spouse dies. And then there's more appreciation in that interval. And so in order to take advantage of the double step up in basis, we want to make sure that the assets of the first spouse to die get included in the estate of the surviving spouse, so that those assets get a step up in basis when the first spouse dies, and then they get another step up in basis when the surviving spouse dies. Now, I will tell you, that little tax strategy for many, many years was a no-no. Back when our estate tax exemption amount was $600,000, and we never wanted the assets of the first spouse to die to be lumped into the surviving spouse's estate, because they may have caused estate tax inclusion in the surviving spouse's estate. And with the estate tax rate used to be 55%, we at all cost, we would arrange for trusts and other vehicles to be arranged when the first spouse died, to avoid those first spouse to die's assets from being lumped into the surviving spouse's estate. But now, with an estate tax exemption of $11.58 million, a threshold that most couples will never get to, now it's the opposite. We want the assets of the first spouse to die to go into the estate of the surviving spouse, so all those assets get another step up in basis when the surviving spouse dies. So with the estate tax exclusion amount in 2026 being cut really in half, we gotta kind of watch that and monitor that. But step up in basis, double step up in basis is strategy number 2. So those are 2 capital gains tax strategies. 1, take advantage of the step up in basis. Number 2, take advantage of the double step up in basis. Number 3 is an income tax strategy, and it's a fairly new one. And so here's the deal. With the new Secure Act, your children or your non-spouse beneficiaries of your traditional IRA, they're no longer going to be able to take distributions that from the inherited IRA that they inherit from you. They no longer will be able to take distributions over their remaining life expectancy. After you pass away, when you name non-spouse beneficiaries, they're going to have to take those income taxable distributions within 10 years of your death. And with many people in their fourth quarter, they're in their 70s, they're in their 80s, and they're sitting on their traditional IRA. And just about everybody out there, and because you're one, you're only taking those required minimum distributions. But many of those people sitting on those traditional IRAs in their 70s and their 80s, they're not working. They're not retired. They don't have any other taxable income. And they're only taking the required minimum distributions, and then they're going to die, and then their child, who is successful and maybe in the highest, roughly 40% income tax bracket, is going to have to take all of that money out of the IRA within 10 years and pay tax potentially at 40%, maybe more. So it might behoove some IRA owners who have been taking out required distributions only to take more than the required distributions and go ahead and pay tax at lower than the highest income tax rates. You're not spending that money, you're paying tax, and then you can invest those funds and allow those investments to get a step up in basis when you die. And that very well may result in less overall tax that the family has to pay on those traditional IRAs, which nobody really likes, because when they realize that they got to pay tax and then their heirs got to pay income tax, it really kind of gets in their craw. But I think we're going to see more traditional IRA owners in the future take more than their required distribution amount at lower income tax rates than allow it to continue to grow tax deferred and have the children pay income tax at higher income tax rates. All right, so that's number 3. IRA owners considering taking more than required distributions during their lifetime at lower income tax rates. Number 4 is, it's a 5-syllable word and nobody really understands what it means, but it's important, and it's what's called portability. So this has to do with when the first spouse dies, even if there's no estate tax return filing requirement. With the estate tax exclusion amount being cut in half in 2026, or at least scheduled to be cut in half in 2026, who knows what Congress is going to do before then. But even if someone dies before 2026, even though there's this humongous $11.58 million estate tax exclusion amount, and even when a married person dies prior to 2026 with no estate tax return filing requirement, it may behoove the family to have them file the return and make the portability election. You don't know what that means, so I'm going to refer you to another video right about there where I talk all about how important it is when a married person dies to make the portability election on a timely filed estate tax return. Again, check that video that I just linked you to. So that's number 4. It's an estate tax savings strategy. And then number 5, it's an oldie but a goodie. It's perhaps start engaging in some annual gifting. People, as you know, most people know you can give, and some people think it's 10 or 12 or 14, but in 2020 it's $15,000. You can donate $15,000 to as many people as you want every year, and you don't start using up some of your estate tax exclusion amount as long as those gifts are within that $15,000 kind of per person limit. And you may think, well, I don't really need to do that because my estate isn't anywhere near the $11.58 million estate tax exclusion amount, so I don't need to start giving away my stuff because if I were to die, there's not going to be any estate tax anyway. Why try to get it out of my estate and in an attempt to save a 40% tax when if I leave it in my estate, it's not going to be subject to tax anyway? And that's a fair argument. However, our estate tax exclusion amount is going to be cut in half on January 1st, 2026, unless they change it, which they might, who knows. So somebody now with maybe sitting today with a $3 to $4 million estate, that's growing, that might be $6, $7, $8 million in 2026 and beyond. They might get caught with a taxable estate in 2026 and beyond, and they can't give it away fast enough. So they may say, boy, I wish we would have started doing some gifting earlier, because now that it's 2026 and I can only give $15,000 to my children and my grandchildren, and my estate keeps growing, there's going to be a really hefty estate tax bill when I die. I should have started gifting sooner. Now, we don't want to do the gifting unless you feel like you have enough in your estate to cover your needs for the rest of your lifetime. So that's another discussion. But considering that gifting now, especially in light that the estate tax exclusion amount is going to be cut in half on January 1st, 2026, may want to consider that annual gifting. Okay, and then I have a bonus, and that's really, really important, so that to make sure that you don't miss any of my future strategies. Really important that you punch the subscribe button, hit the notification bell, and maybe most important, give it a thumbs up to please the YouTube algorithms. Algorithm is almost as complicated a word as portability. So there you have it. 5 strategies to help your family avoid tax. I went through them kind of quick, but felt like I hit the high points good enough for a video like this. Also, real important that you stay tuned. Tune in 10 a.m. Central Time every morning. As long as I get those subscriptions and those likes and I see those numbers going up, that'll give me the motivation to keep taking the time and effort, which is fine with me, to continue educating our estate planning community. Okay, we'll see you tomorrow.